Hello, everyone. This is the second episode of GreenSky's podcast. We have Mike List here again with us as our guest, and I have Marian Hoffman, my co-host. Today, we want to dive deeper into venture capital as an asset class, venture capital performance metrics, and discuss a bit about GreenSky and how we've been performing over the years. So maybe I start with you, Marian. Maybe you can explain for our viewers more about venture capital as a whole. What do you think of the asset class? You come from the public market. Share a bit of wisdom about your experience and where you see venture capital fit.
Sure. So, I think venture capital is a less familiar part of the investment spectrum, and it certainly has a very different risk return profile than a lot of other asset classes, and particularly on the public side. And so, I think it's really important for people to understand what that looks like, because from an outside perspective, often venture has a particular reputation, and as sort of being boom and bust, and certain kind of viewpoints that exist about the asset class. But when you actually drill down and look at the numbers, what's really impressive is that when you compare the returns for the venture capital asset class over long periods of time, whether you look at 3 years, 5 years, 10 years, 20 years, those long-term returns of the venture asset class, it's outperforming, or certainly very competitive with other areas within the private markets as well as on the public side of things. So it is very much, while it may have perhaps more volatility throughout that period, over the long term, it has proven itself as an attractive asset class to invest in. It's also certainly an attractive diversifier and a balanced portfolio, having the different pockets of your portfolio. Venture capital has earned its place as being in that private markets and alternatives bucket. I think very much so. Maybe 20 years it was more of a newcomer, but it certainly no longer is now. And I think what's also really interesting about the asset class, which is often less discussed, is the attractiveness that comes from the dispersion of returns that exist within the asset class. And so what I mean by that is that if you looked at kind of what like the highest manager versus kind of the lowest manager might be in venture versus other private market asset classes and versus other public markets, it has a very wide, the highs are higher, but the low might be lower than other asset classes. But what that means is that there's more opportunity if you're able to find a manager who's able to earn outsized returns. There's more opportunity for you as an investor to earn outsized returns. So kind of at the opposite end of the spectrum, if you're in a very, very efficient market like the US large cap public market space, the difference between your best manager and the least good manager in looking at all the funds might be very narrow. So the opportunity to capture outsized returns is low. Whereas on the venture side of things, that dispersion is much higher, which I think is really exciting for investors, and then exciting for GreenSky as well, especially given what our return profile looks like. So maybe I'll turn it over and you and Mike can speak a little bit more to the return side of things for GreenSky.
And Mike, did you want to add anything about the venture capital asset class as a whole?
No, I was just going to ask Marian if she knew of any good managers, given that it was important to pick a good one, if she had flagged any during her brief tenure in venture so far.
I have, funnily enough.
Okay, good. Excellent. Well, let me know at the end of the podcast.
So, okay, let's say I'm interested. I want to invest in the venture capital asset class. How can I do that? What are some of the ways that I have?
So in Canada, fortunately or unfortunately, depending on your perspective, we have securities laws that mean that in almost all cases, to effectively invest, you need to be what's called an accredited investor. Those typically are standards of annual income for either 2 or 3 years, either yourself individually or your family unit. But you essentially need, the OSC, the Ontario Securities Commission, has said you need to have a certain amount of financial health to be in a place where we're going to let you invest directly with outside of a prospectus, so outside of a long, large document that you would otherwise be given You see prospectuses used for public offerings, etc. But in the case of venture, all of the folks that invest, certainly with GreenSky, and we check this very carefully, and I would suspect with almost every other of our peers, are what are called accredited investors, which means they meet some form of a financial threshold here in Canada. So that's kind of the boring answer. The more interesting answer is that I think to invest in this asset class on your own, and I'm speaking as somebody who has done this, I was an angel investor for 3 or 4 years, is more akin to gambling than it is to actually prudent investing. The fact is that there are simply so many failures in the venture asset class that if you don't invest in a differentiated broad portfolio, I think you run the risk of simply picking the ones that aren't winners and losing a significant amount of your money. What Marion has flagged, which is this large difference inside the venture asset class between managers that are performing at a very high level versus those that aren't, in large part, I think, is driven from those managers' abilities to pick winners and double down on winners. And that comes with a significant amount of experience and homework on each deal that in many cases, individual angel investors, in my experience, aren't often able to do.
And Marion, I know you were an LP of GreenSky before joining us. I'm curious to know what made you decide to, first of all, invest in venture capital asset class, but then also how did you decide GreenSky is actually the one?
That's a good question. I think we were looking to diversify, as you said. We were certainly, my husband and I were heavily invested on the public market side of things, and I think we had some alternative investments and some in the private space, but we were looking for others and wanting to find a manager. It was less, let's go find a venture manager. It was more about finding a manager in that space that we felt really aligned with. So again, coming back to some of the themes we've spoken about before about, are they invested alongside of us? How long has the team been doing it? What is the nature and the background experiences of that team? What kind of process and philosophy do they bring to that? Those are kind of the important pieces when you're looking for a manager.
Awesome. And I guess either Mike or Marion, what do you think, if you want to share with our viewers the performance metrics, the quantified performance metrics that are important for deciding which venture capital firm to go to and invest through them, what would those metrics be?
I mean, I'll field this, and Marion, you can jump in and correct me after I'm done making a bunch of mistakes. But the way that I view, and we've done a little blog post on this, is the value at a given point of our funds, or any of our funds, any one of our funds, is the TVPI, which is total value paid in capital. And it's made up of 2 distinct pieces. One is kind of hard assets, which are basically dollars returned to our LPs, to our investors. And one is notional value. So it's the value of the companies in which we've invested prior to their exit that we kind of benchmark. In the case of most funds, I would argue almost all funds, at the inception of the fund, once you've deployed all the capital, almost all of the value is collected we call it behind the curtain, but in a collection of assets that haven't realized the terminal value. They haven't been sold and the cash has not yet been returned. So the value is notional. We do our best to kind of mark to market, and I'll talk about that in a sec. But at the end of the day, we don't actually have a concrete value. As the fund progresses and it begins to realize the sale of many of the different investments and cash comes back, and we then distribute that cash out to our limited partners, our investors, more and more of the value is concrete rather than notional. So basically at day 0, when the funds are all deployed, 100% of the value is notional. And at day 100, when 100% of the companies in which we've invested have either failed or more likely and hopefully have been sold, all of that value is concrete. And so what we call TVPI, which is total value to paid in capital, is made up at any given point of notional value and actually concrete value. we have numbers now on our first 3 funds, which we've aggregated because the funds are somewhat small. Our 4th fund we finished deploying early this year, and that was fund 4. We're now in the middle of deploying fund 5. So we can't speak meaningfully about returns on 4 or 5, but we've kind of aggregated the data and the performance metrics on the first 3 funds, and I will throw that over to Marion. You can share with our viewers those metrics.
Thank you. We do spend a fair amount of time wanting to really understand our numbers and, where possible, compare ourselves to our peers. That's obviously important, is understanding where we sit within the investment landscape. And it is challenging to sometimes get that data, but we've managed to get what some of these numbers look like in a North American context. So both Canada and the US, because certainly GreenSky wants to compare ourselves to a broad peer group as possible, really. And ideally, we are able to best them all. And so when we look at some of our numbers, when we look at our DPI, the distributed paid in capital, distributions paid in.
Which I'll interrupt quickly, Marion, just to point out for our viewers, DPI is our North Star. So it is the single most important metric because it actually represents a multiple. So DPI of 1.0 means we have returned exactly the same amount of cash that we took in from our investors. Anything below that, we've yet to return the total value of the investment. Anything above that is proceeds. And sorry to interrupt, but I just thought that is GreenSky's North Star, that metric.
And that's the one that we do put the most importance on because, as Mike talked about, that's the one that's actually realized. That is hard cash that we've returned to our investors. And certainly TVPI is something that has importance. We certainly think that there is value in all the investments that we've made in the ongoing and enduring companies are in the portfolio, but those haven't been realized yet. So in some ways they are more subjective. And so while it's important to look at that, and we think our TVPI number is certainly very competitive relative to our North American peer group at 3.2 times, it's really when we look at our DPI where we're most focused on that. And when we look at for those first 3 funds, as Mike talked about, the DPI that we're looking at is in the 200-210% range, approaching 213%. And that definitely puts us at the upper end of the North American peer group, in the top decile or quartile, depending on the fund. So that's something that GreenSky is really proud of, and something that is really a reflection of the work that the team's been doing for so many years.
Yeah, and I would say at 213, I want to translate just so everyone's very clear what that means. For every dollar that, on average, and again, it varies slightly by fund, whether you're fund 1 or 2 or 3, but on average, if you aggregate them all together, for every dollar you would have invested in one of those funds, we would have returned to date $2.13. That does put us in the top decile for each fund. And it also doesn't include a significant number of investments that haven't yet exited. So I don't know the exact numbers, but I suspect I think it's something like 13 or 14 total companies across, or 16 or 17, whatever it is anyways, across those first 3 funds. I should probably know those numbers. But the DPI that we've created to date is on only 4 exits. There are more coming. I shouldn't say for sure. I'd be pretty shocked if there weren't more coming. But we do believe there are more coming, which will mean that $2.13 or 2.13 DPI number will increase over time. And that is the concrete part of what I was talking about earlier, of that total overarching TVPI, which is total value to paid in capital. It's easy to mark the DPI because it's simply the cash returned to LPs. The residual value, the other half of that bucket, we mark to market by simply using the last price per share at which a company raised money. So we don't try to do anything fancy. We don't try to impute any kind of revenue growth that one of our investment companies might have realized over a certain period. We just look at whatever the last round at which the company raised money, and we use that value to market. So I would argue that in most cases, our value at which we book a lot of the companies that have yet to exit is somewhat conservative. I think a lot of our peers do this, so it's not like we're doing anything that's noticeably different. But it does mean that for the 2.13, the $2.13 of DPI realized, that is only what we've realized to date. And we certainly would hope to see that number increase over time.
Great. So I've realized neither of you discuss internal rate of return or IRR as our North Star. And so why don't we dive deeper into IRR, why IRR is not our North Star and DPI is, and like how, let's say, the IRR number translates into DPI or performance.
I mean, I'll go super quickly. IRR is a number that measures almost it is tied almost directly to the way in which a manager chooses to value assets that have yet to exit inside a portfolio. And the danger is that the IRR is, and I'm not suggesting that this is not a pejorative comment, that there is intentionality here, but DPI, you can't cheat. DPI is simply money I've handed back to somebody. And unless I'm just outright lying, the DPI number is a very accurate gauge of health because there's no fuzziness to it. Whereas IRR really does drive off of the value at which the managers are booking their investments. And again, if those values aren't accurate for any reason, intentionally or otherwise, that IRR number is similarly not going to be as accurate. What you saw during the very frothy period of 2021 and 2022 was a lot of large global venture firms booking their investments at very inflated values. Not I think in a misplaced way. It was simply because the underlying multiples for some of these industries were so high that they could justify booking IRR numbers that were high. As the public markets and other markets, as those multiples came down, a lot of those managers were forced to do corresponding write-downs of the IRR, which very much impacted that IRR number negatively. GreenSky didn't do that. We may eventually, if our companies begin to raise on down rounds, that'll obviously force us to drop the numbers given the system we use to book IRR. But until that happens, and it happens in a significant way, our IRR numbers would remain constant. And again, because of what I've just explained, DPI is the North Star versus the IRR. The IRR is obviously an important number, but because it's a little more subject to the way in which you choose to book value that has yet to be realized, it isn't the North Star that we've chosen to measure our performance by.
Thank you. And Marian, may I ask you to kind of summarize the performance metrics for our viewers, the three performance metrics that we discussed?
Yeah, so we're starting with the one that we think is the most important, which is DPI, and that's sitting at 213%. The other metric that is typically looked at in the industry is obviously TVPI, and that's at 3.2. And then the IRR, which is at 28%. And that is for aggregate across our first three investment funds.
And Marian, do you want to explain quickly one more time what each of the DPI, I think we've beaten that one to death, but what the other two actually mean?
Yeah, so the DPI one is the amount that we've actually handed back. So that is cash that has been handed back to our investors as a percent of how much they've handed to us originally. So they gave us money. We had to go out and invest it. When we exit or sell or get money back, we hand that back to them. And so at 213%, that means that we've handed back 213% of the money that we were originally took in. So that's the one that we put our most focus on. IRR is taking over on a yearly basis, and it's looking at the TVPI and then looking at what the implied returns are on an annual basis implied by that TVPR. So that includes both the amount that we've actually handed back, as well as this notional amount that's residual in the existing portfolio companies that remain within the portfolio.
Perfect.
Great. So we've established that venture capital is an exciting asset class. We've discussed the performance metrics. We shared what are the GreenSky's performance metrics, and we established GreenSky seem to be doing well. My question is, what is it that made GreenSky succeed so far? What is the secret sauce? What do you think has resulted in the performance numbers that we are seeing today?
All right, I'll start, and Mike can certainly jump in. I think there's a lot of different pieces to it, and so I'll start with obviously the team. I mean that's the starting piece of any investment manager. That's your greatest asset. So certainly that would be a key part of what's contributed to GreenSky's success. We've talked about the experience and the depth of knowledge that comes from the team and what that brings in terms of our ability to filter the deal flow that comes through, what it means in terms of the network, the proprietary network that GreenSky is able to access in order to access deal flow, and the quality of that deal flow that comes into the firm, I think is quite unique because of the caliber of the team. It also then flows through in terms of our ability to assess those companies, the due diligence that we do, the wide range of experiences and backgrounds that the team has, I think enables a really critical analysis of the business, and an ability to look at it kind of from a 360 perspective and really understand where are the weaknesses, where are the opportunities. So I think it plays out in that respect. I think it's also another piece that's outside kind of the team, and what it brings is the way GreenSky manages their portfolios. That the team is not looking to invest in just kind of a really large number of names that they may have a superficial understanding of. GreenSky's running concentrated portfolios with high conviction companies that we're investing in. And so that means that the team's done really deep diligence on those companies. They're the ones that we believe in the most, the management teams that we believe in the most. And then it's a smaller number that our team then focuses our attention on helping them grow and succeed. Maybe I'll ask Mike to jump in as well.
I mean, I think that's a pretty good summary. I don't have a lot to add. Again, having been, I often am sitting in meetings on our regular Wednesday meeting. We all get together in the morning to review the portfolio, and I'm often struck by, I never would have thought 10, 12, 13 years ago that we would have built this into what it is today. And in particular, the caliber of people that we have somehow managed to attract. A lot of smoke and mirrors, but that we somehow managed to attract onto the team. It's remarkable. And so there are lots of little specific answers. It really is a complex question. There isn't one thing that makes us unique. It's a bunch of the things that Marion touched on. Other than I would say that the strength of our team is remarkable. And I do think it's ultimately what will continue to, it's what's generated the success to date, and it will continue to generate success going forward.
Great. And so I guess my last question is that what is it that we see for GreenSky's future? I decided that GreenSky is amazing. I want to invest. What is an opportunity for me to invest in GreenSky's funds? What the future holds?
I think I'll start. Mike can jump in. I think it's an extremely exciting time to be investing in the venture asset class, and for GreenSky in particular. We're really excited. We're going to be starting fundraising for our sixth fund, and it's a particularly opportune time to be allocating capital into the space. We've come off a period of tremendous cash infusions into that space, and the resulting has been, you've seen that in terms of activity levels, in terms of valuations, and we're coming to a period where things look different. There's more uncertainty in the market. We're seeing a lot of people retreat from the venture space. Valuations aren't what they used to be, and the capital inflows aren't what they used to be. And there's certainly it's common knowledge across asset classes that those are where when capital's kind of moving away from a space because of uncertainty within that space, that's typically when the best opportunities arise, and when it's the best time to be going in there, because you want to be going into an asset class when capital isn't plentiful and there's tons of it and it's driven down returns. You want to be going into it when there's a lot more opportunities. And so I think that we're seeing that right now in the venture space. And so I think GreenSky is really excited to be fundraising, and then getting a chance to invest that into a really attractive space for venture.
Yeah, and I agree completely. Our colleague Greg Stewart often, I think it's Buffett says, when others are fearful, be greedy. I mean, that it couldn't be more a better descriptor of kind of what I feel now. And like I've been at this since I sold my first company in 2000. Like I've had a long history with startups, and I've seen the space develop and go through kind of a number of different macro cycles. And I would say that it is my opinion that we are about to enter into a period, I don't know how long it's going to last, but of maybe 18 to 36 months where the value at which deals are getting done are historically low. The amount of capital in play looking for particularly deep tech, the kind of deals that we look for here in Canada, is low. And therefore, the opportunities that will present themselves over the coming, again, I think it's going to be a year and a half to 3 years, and maybe longer, who knows? I don't have a crystal ball, but that period is going to be one in which the investments that it's in many ways it's a simple math problem where you had multiples in 2021 that were in the 25 to 35x, and the way we kind of book our multiples is we look at a ratio that is the numerator would be the pre-money value at which you invest, and the denominator would be the revenue at the time you're investing in the company. So for example, if you had a company worth $10 million pre-money that had $1 million of revenue, that's a 10x multiple. In 2021, 2022, those multiples in some cases, particularly for enterprise SaaS, were upwards of 25x, if not 30 or 40x. They're under 10x now. The historic average, I suspect, is somewhere in the 8 to 10 range. You've gone from a period where the market was incredibly frothy to a period that will last for some amount of time, where I believe that the multiples at which you get into these investments are lower than the historic average. If you make the assumption, and I think it's a fair one, that on balance, things will level back out and those multiples will go back to what we are typically used to seeing, you get a lift just by virtue of making investments during this just relatively depressed time for venture. This is the time, if you want to make your first foray into venture. It is a really, really good time to be a venture investor. And I will have to conclude in a self-serving way by saying that we view ourselves, certainly the numbers suggest that we're one of the top managers now operating in Canada. If you're interested in the asset class, Fund 6, we're opening up the process to raise Fund 6 in January of 2024. So we'd love to hear from you. Certainly we have all of our LPs have come through referrals or have come through folks that we know. So we don't tend to reach broadly out. But if you are interested in what we're doing and you want to have a chat, feel free to reach out. There's information on our website at greensky.vc, but we'd love to chat with you.
Awesome. There you have it, folks. Venture capital asset class and how GreenSky operates.
Thanks, guys.